Hello, my name is Grant from beatthemarketanalyzer.com, and I'll save you all the BS and marketing hype and just get to the point. Today I'm going to tell you about how to beat the stock market, but not just how to beat the stock market, how to beat it consistently. I'll then tell you 5 ways to make more money with less risk, and finally I'll tell you the first step that you should take today to start beating the market. Now this system is based on Warren Buffett and Benjamin Graham's value investing technique. Value investing is a stock investing technique that is based on factual data, and it works. How well does it work? Well, during 43 years of investing from 1965 to 2007, the S&P 500 has returned 6,840%. During the same period, Warren Buffett's value investing technique has returned 400,863%. That's over 57 times greater than the market return. And it's not just Buffett and Graham that use this technique. There are other value investors such as David Dodd, Charlie Munger, Martin Whitman, John Templeton, Joel Greenblatt, Christopher Brown, Mason Hawkins, Irvin Kahn, Whitney Tilson, and the list goes on and on. But I won't bore you with their details. You can look up their track records, which speak for themselves. Now I'm going to tell you the secret to beating the market consistently. What you want to do is invest in good companies at bargain prices. Simple, right? It's a simple and common sense approach, and it's the same in real life. If you're going to buy a product at a store, you want to buy a good quality product at a bargain price. It just makes common sense. Now, it's the same thing with stock investing, but people complicate it. Now, why do they complicate it? Well, for various reasons, but the media complicates it because the common sense and logical approach to stock investing is not sexy, it's not exciting, and it doesn't sell magazines and get airtime. What they're interested in is the latest or greatest investment, hot picks, IPOs, penny stocks, things like this that cause excitement and the ups and downs and fluctuations of the market. Stockbrokers, they complicate it and try to confuse you so that you'll be scared to invest on your own and so that you'll use their overpriced services. And then people in general, the general public, they just feel that if it's too simple, too logical, then it just can't work. There must be some kind of mysterious secret to investing. Okay, so those are the reasons why people complicate stock investing, but it doesn't have to be complicated and it doesn't have to be confusing. Now I'm going to tell you about the 5 ways to make more money with less risk. Number 1, you want to stop believing the BS. Now, there are many people out there that do chart reading, stock forecast, and predictions, and they believe they can read the mountains and valleys of the stock and what's going to happen tomorrow. And pardon me, but this is all bullshit. Nobody knows what's going to happen from day to day, and your guess is as good as mine. So instead of believing this speculative guessing, trust the facts and base your investments off proven data. Number 2, don't short-term speculate. Now, the short-term movement of the market is mostly based on speculation, and 2 emotions are greed and fear. People get greedy, and they get excited, and they buy, and then they get scared and worried, and then they sell. So the market goes up and down and has these fluctuations from day to day, and even hour to hour or minute to minute. So instead of focusing on the short term, what you want to do is focus on long-term, 5 to 10 years, of an individual stock's historical performance, and that'll give you a real feel for the stock's movement. Number 3, you want to prevent information overload. If you go to Yahoo Finance or Google or MSN Money or CNN Money, there's so much information, financial reports and statements and all of this criteria for investing stocks and marketing hype. Do not overload yourself with these fads and trends of money magazines and investing media. They're just going to confuse you and sidetrack you. What you want to do, as I said, focus on individual good companies and a few criteria that prove these companies to be good quality and find them at bargain prices. Okay, the next thing is number 4, avoid penny stocks, IPOs, and mutual funds. Now, with penny stocks, 95% of penny stocks fail. They're very risky and they're not proven investments. So you want to stay away from them. IPOs, Warren Buffett has said that IPOs are almost always a bad investment. IPOs have no proven track record. They don't have the 5 to 10 years historical data, so you can't really tell how they're going to do. So mostly investing in IPOs, it's speculative and it's guessing and very risky. Mutual funds. Now, mutual funds are very popular, and our media has made them the thing that you should invest in, and also stockbrokers promote them. Now, why did they promote them? They promote them because it's an easy package. It's an easy vehicle to invest your money, and they put your money in this, and then they don't really have to worry about tending to your account, and they just collect your maintenance fees. Also, they're so watered down, so diversified, that they never really make a lot of money, and in most cases, they don't really lose a lot of money either. They're just kind of so-so, and you'll never really see much gain out of them. The other problem with mutual funds is their fees. Their fees are very expensive when you're using traditional brokers, and even if you do make a return, usually it's reduced by the fees, or sometimes you just break even when you add in all your fees. Here's an interesting fact about mutual funds. Out of more than 7,000 mutual funds, 8 have beat the S&P 500 every year for the past decade. Seriously, 8. And that's one of the most important statistics that you'll want to concentrate on when thinking about investing in mutual funds. They're just not a very good investment to make a lot of profit. Okay, number 5, stop giving your money away to money managers. Here's an interesting fact. Over 70% of fund managers fail to beat the market consistently. There was even a coin flipping experiment where they took 300 college students' ability to guess heads or tails on a coin versus 300 money managers to guess good investments. Turns out the money managers had no better chance of picking good investments than the college students had at guessing heads or tails. Therefore, we can assume that money managers have no better chance of picking stocks than we do. Also, money managers typically charge very high fees. My money manager, for example, charged me $30 to $40 per trade. And that's typical, usually $30, $40, sometimes $50 more per trade. Whereas if I use my online trading account, I only pay $10 or less per trade. Also, most importantly, money managers don't care about your money as much as you do. And that's the realization you have to come to. Therefore, I think that we can all agree that based on this information, we're actually better off taking control of our own money and investing in safe, quality companies at bargain prices. Now, what can we do today to take control of our money and start beating the market? Well, the next step is to set up an online trading account. And you can set up your online trading account with many different trading account companies. I personally use Scottrade, but there's TradeKing, E-Trade, various other ones. They're pretty similar. It doesn't really matter. Scottrade, for example, is especially easy to set up an online trading account. You can set up the account all online for free and actually start trading within the same day. Scottrade also offers some promotional codes for free trades. If there are any current promotional codes, then I'll post them in this video. You can use these promotional codes for free trades, discounts, or something like that. If you already have a friend who uses Scottrade, then you can use their promotional code. If you already have a traditional brokerage account or a money manager, then it's also very easy to sign up an online account and then just transfer everything over from your money manager to your newly set up online trading account. After you set up your online trading account, the next step is to find good companies to invest in. Now, this technique is based off of Warren Buffett and Benjamin Graham's value investing technique. So first I'll talk about how to find good companies, And next I'll talk about how to find bargain prices. First, how to find good companies. Let's look at what Buffett did to find good companies. He looked at earnings performance, share price growth, debt levels, profit margins, owner earnings growth, and handling of shareholders' money. Now, if you're confused by these terms, don't worry, it's understandable. Even experienced stock investors get confused because there's a lot of data out there, and sometimes too much data, people get overwhelmed. The good news is that you don't need all of this data, and there's a few essential criteria that we're going to focus on, so you don't have to worry about the rest, which will sidetrack and confuse you. So most importantly, we want to look at return on equity, which is ROE, and also dividends yield. Now, return on equity is very important, and it was one of Buffett's favorite measurements because it took into account a lot of things in one measurement, such as income, assets, debt, profit margins, and other things. And it gives you an overall view of the company's performance. Another thing we're going to look at is dividends yield. Now, dividends yield is important because it tells you directly how much money the company is going to pay you. Now, this criterion directly affects how much money you make. Now, other people focus on different criterion, and sometimes this criterion doesn't really affect you directly. Such things as unemployment levels, politics, currency rates, things like that. It has very little direct effect on the bottom line, which is how much money you're going to make from your investment. So instead of focusing on this stuff, just focus on the most important essential criterion that will give you the best overall picture of the company's performance. Along with return on equity and dividends yield, Buffett would also look at other criterion, such as 5 to 10 year price growth, 5 to 10 year earnings growth, or EPS growth. He would also look at ROIC, or return on invested capital, gross profit margin, PEG ratio, or price earnings growth ratio, and the ability of a stock to recover during an economic downturn. So just looking at these few criterion instead of all of the information, we're drastically reducing the overload of information in evaluating stocks. Now, this is great for us because it saves us a lot of time in finding good companies. The problem is that even with a small number of criterion, the manual process of evaluating stocks is often tedious and takes a long time. I know from personal experience, it would usually take me 30 minutes or more to analyze one stock manually. Now, the reason why it took me so long is because I would set up an Excel spreadsheet and I would go to different websites such as Reuters, Yahoo Finance, MSN Money, and so on, and I would find the data that I needed. The reason why I had to go to different sites is because not all the information is on one site, so you have to jump around. The other thing is that sites will often charge you a fee to get this data. They don't provide all of the data for free. And especially when you're trying to get 5 to 10 year historic data, they'll often charge you for this information. So let's say that we did get the data that we needed, and we punch it into our Excel sheet. Now we still have to compare company A to company B and see which is the better company. After we do that, we compare company A to C, and so on. Now, doing this can be very educational because you can see the strengths and weaknesses of each company. But you can see that it'd be very tedious and time-consuming. Plus, you're limiting yourself to the amount of time that you have. You couldn't analyze 500 stocks in one afternoon, or even in 1 week. So you're really limiting the number of good companies that you can find. But let's say that you do find a handful of good companies. You still have to find out if these good companies are at a bargain price. So now I'm going to talk about the second part, how to find out if a good company is at a bargain price. So how do we determine if a good company is at a bargain price? Well, we're going to use Benjamin Graham's intrinsic value formula. Intrinsic value is an estimated value of a company based on earnings and other factual data. Once we find the intrinsic value, we can find out if the company is at a bargain price. For example, let's say that company A has an intrinsic value of $100 and the market price that it's selling at is $60 per share, then we can see that its value is more than its selling price, and therefore we can say it's at a bargain price. But before we buy, we'd still want to make sure that we're safe and eliminate our risk even more. So what we do is we'll add a margin of safety. So even if we screw up and overvalue the company, we can still reduce our risk by adding this margin of safety. Now, how does the margin of safety work? Well, let's take the intrinsic value, which was $100, and we'll reduce it by, let's say, 50%. 50% would be our margin of safety. Now, with this stock at $100 and a margin of safety at 50%, the maximum price we'd be willing to pay is, of course, $50. But the current price is $60. So when considering the margin of safety, this same stock is no longer at a bargain price. So this is how we would determine bargain price. Now let's put it all together. You'll take each of your good companies and find out if they're at a bargain price. And just so you know, it won't be easy to find the combination of a good company at a bargain price. Out of 100 stocks, you might find one good company at a bargain price. But when you do, it'll be worth it. Finding a good company means safe and consistent returns with good growth potential. Finding it at a bargain price means lowered risk with higher returns. This is the concept of value investing, and it's definitely worth it. Keep in mind that you can do this manually, like I used to do, or you can use a faster and more accurate method, which I use today. Hey, I'm going to show you how I use the Beat the Market Analyzer to buy stocks. It's also known as the BTMA Stock Analyzer. So first, I just hit Analyze Stocks. And then if you don't know the company name, you could type in the company name here, or you could just click on the indexes. If you want to analyze the Dow 30, you would just hit this button to analyze the Dow 30. And then it'll analyze all the stocks for the Dow 30. And then they'll show up down at the bottom, all analyzed. And so it has Nike at the top. Nike is a good company at a bargain price. It's a recommended buy. These ones are good companies, but the price is too high. And then you can also set a margin of safety. So for example, if we analyze the S&P 500, then it will analyze all those stocks, and it will tell you which ones are the best buys at the top. They're in green. Tells you what price you should buy at. Then these ones are possible buys, also good to buy. And then as you go down, the stocks just get riskier as you keep going. As you can see, it's pretty fast. It'll analyze 500 stocks in just a few seconds. Then if we add the margin of safety, basically the higher you go up on the margin of safety, then you're being more conservative. But the drawback of that is that you'll limit your opportunities. You see how it went down to only 3 recommended stocks now when you add a 15% margin of safety. Okay. The other thing you could do is you could just have your own list of tickers you want to search. You can get those anywhere you want. You can use the 52-week low tickers or any index. And you retrieve those, and I have it already set at a 15% margin of safety. Go down, and you can see which ones you like. Out of these, I actually like Carter's, and I know of this company. They sell baby clothes, children's clothes, and you can go through and look at the information for the company. So they give you the company rating out of 100, 70 points and plus is a good company to buy. This one's at 82, so a very good company to buy. It breaks the company rating down and tells you the scores. If you want more detailed information on any of these, just click the stock ticker. And it will break down each category and the score. And if you want to figure out how these are calculated, then you can just click on the question marks that give you more information about that. Then you can check out stock value as well. This gives you intrinsic values, and not just one intrinsic value. You have one here, but it's actually broken down into various intrinsic values. So it gives you price earnings model, residual income, discounted cash flow, and then it gives you different situations. If the growth was similar as the past 5 years, the analysts forecasted next 5 years forecasted growth. If it was at 10% growth rate, 3% like inflation rate, or at 0% growth rate. And yeah, it breaks these down into each one, and then it gives you your average here. And then when you go back, it removes outliers and normalizes the information to give you one intrinsic value here and an estimated value of the stock. It also uses a Buffett valuation comparison method. This gives you the expected annual compounding rate of return. So you can see that CARR's is at around 12%. So that would be a good return. Gives you pricing information. So you can see 52-week highs and lows in the midpoint. So at 95 is the midpoint, and right now it's at around 79 something. So you can see that it's pretty low compared to the midpoint. It's only about 0.75% away from the 52-week low. So this might be a great time to buy this company. Look at the fundamentals here. And you could see here that less than 1 could be good. It's at 0.75 for the debt equity, the P ratio under 16, and this one is very close to 16. And then the current ratio greater than 1, and this is greater than 1. It also has a dividend, gives you market cap, and you can go through all of these. If there are any problems here, then it'll be marked in red. You can see CARR's doesn't have any problems according to that. And then you can also check the complete view here. So this just gives you all the information, and you can just scroll over, just check everything with the 10 years of EPS, the valuation models, the pricing, fundamentals, just everything all together. And you can also export that and sort it any way that you like. It'll sort right into Excel just by clicking that. Okay, so anyways, yeah, I like CARR's, and I think I'll go buy that. So here's the recommended price, $79.80 right now, and I'm just gonna go. The actual price is actually still changing right now. Just go check out. So the current price just went down. It's at $79.74. I'll go to my Scottrade account and go to make a trade here. Okay, I want to buy CARR's, which is CRI. And I almost always use limit orders. And I'm going to set it good till date. Now my price, as I said, it's at around $79.74. The analyzer recommended that at $79.80 it's a good price right now. But I'm just going to look at what it's been doing and how the movement of the stock has been. So let's look at the 2 years.
You can see the days range here between 79.68 and 81.74, the 52-week range 79 to 112, and then here's the 2-year movement. You can see it's pretty much at the lowest point in 2 years, so we're probably at a good bargain price right now with this. And as I look at the 1 month and 5-day, I could see that the movement is maybe between like 50 cents and $1. It will go up and down each day. So I'm going to go down to the opening price was $79.80. I'm going to put in a price at around $79.60, which I think it's possible to get that. If not today, then sometime this week. So I'm going to put for $79.60. And in this account, I have 13,000 available for trading. So I'm going to trade 10,000 divided by the 79.60 and about 125 shares. So put in 125 shares. Review my order. Yep, that's correct. And it's been confirmed. So then I'll just wait now and just see if it goes through. And then if it goes through, then I'll probably set a limit order again to sell at whatever my desired return is, and that way I don't have to watch the market or anything like that. I just let it sell whenever it's ready to sell, whether that's 5% or 10% or whatever I decide. Okay, it is now the next day. I just wanted to give you a little update on what happened with Carter's CRI. Right now through Yahoo, I'll just update the page. You could see that it's at 79.20. I had originally set my limit order for 79.60. Okay, just dropped down to 79.09. So it went below my buy price, my limit order price, and therefore my trade was executed. I bought Carter's CRI. This is my Scottrade account, and you can see here I bought CRI 125 shares, and this was my order price, $79.60. Okay, and there's the dates. And then I immediately set a limit order after I bought it to sell it, and I set it at around 5% gain I wanted to get on this stock. So I set it for $83.58, and now I'll just simply leave it go. I don't have to watch the market or anything, and just wait till my limit order executes and for CRI's stock price to cross over this $83.58 for it to sell. So I'll update you whenever that happens. Okay, I'm back 3 days later. It's now February 10th. You can see that CRI Carter's is now $83.88. Let me just refresh the page here. Yeah, it looks like it's still around $83.88. If I go over here, you could see that I originally bought CRI 125 shares at $79.60. The trade date was February 7th, and then here on February 10th, I sold. It's just split up into the different, it was partially sold on these, so it adds up to the 125 shares. It was sold at $83.58, which ends up being a 5% gain. I've done this same thing with 4 other companies in the past week and a half, and it works. So it's just a way to show you that you can use this beat the market analyzer to quickly find a handful of good stocks at a bargain price, and you're really at an advantage because when other investors are just analyzing stock by stock, you could basically just put in the whole S&P 500 or Russell 3000, or for that matter, you could put in the whole 6,000, 7,000 stocks in the U.S. stock market and quickly analyze them within a few seconds, and you'll have, a few of the recommended and possible buys at the top, and you don't have to waste your time with the other risky stocks. And then you could just rinse and repeat this cycle of buying and selling. I usually am able to buy and then sell within about a month and a half, getting a 2.5% to 5% gain, and then I just rinse and repeat that process, and it ends up compounding my profits very nicely. So I find the same thing with my customers that use the Beat the Market Analyzer. So give it a try and see how you like it, and let me know. I'm always glad to hear feedback, good or bad, from my customers. And I hope you enjoyed this little review about how to use the Beat the Market Analyzer. I'm Grant Gelati. Have a nice day.